So what Vanderbilt did, kind of like at 100 Oaks down here, where they took that and they're doing the same thing at a big retail center down in Tullahoma. They're doing the same thing. They're turning that all into medical office. So I'm gonna basically turn the time over to Kanal, who is an agent with us, and he's gonna be very quick because he's got a project that he's trying to get through zoning, and so they have to go and appear with that. So, but I'm gonna let him start with Andy, and then I'll take over.
So I'm gonna introduce Andy Zhu. He's our guest speaker for tonight. Met him, it's been, I guess, a year and a half now.
Yeah, a couple years.
We met through ULI. I don't know if many of you guys are in ULI. I guess I'll go to this side.
Sit down. The official.
I'm gonna be here really quick because I was supposed to leave at 2:20 and it's or 5:20. It's already 5:19. So it'll be like really like literally a minute.
All right,
I'll be
speed
out of
run.
here. So I'm gonna let him introduce himself real quick and then I'm gonna jet.
Hey everybody, I'm Andy Zhu. I'm Director of Business Development for Pentagon Holdings. We're a built for rent and multifamily development firm based here in town. We've got a portfolio of about 1,600 units that we're building between here in Nashville and in the Huntsville submarkets. I also run with my partner Joseph, who is sitting there in the purple, MFX Ventures, which is a consulting company focused on the financial analytics around real estate models. We really like to dive deep into creating complex valuations, affordable housing, debt structures, and all that kind of stuff. So we help people who, either don't know how to or want to just take a further step in analyzing their deals, or just don't have the time to go all the way in depth and spend time in Excel all day, because believe it or not, that's not everybody's favorite thing to do.
Yeah, so Andy's got a pretty nifty Excel model that he's prepared for you guys already. It's going over actually one of the listings that we've been working on off market. It's 142 units in Jackson, Tennessee. So he's going to kind of go through that, evaluate that part through with you guys, and then we're going to shift over to affordable housing for the end of it. So I'm gonna let Brian take over. I'm gonna get out of here real quick. Thank you guys.
Good luck, boss.
You were talking about Excel. You're talking about Excel spreadsheets, not Excel like real estate.
Yes,
Right.
yes, these are the Excel real estate
Yeah,
experts.
okay, there you go. Yeah. So, all right, move over here, Excel. So I think you're gonna kind of take a deep dive or go into the underwriting on this deal and kind of what that would look like from kind of like an institutional
Yes, exactly.
company that might be looking at this property. Is that correct?
Exactly. And I want to make it interactive. So anyone who has questions about how to, dive deeper into this stuff, I don't want it to be too in the weeds either. So we want to scroll. Actually, yeah, if we could scroll down just a little bit, we'll get to like this part where it's like the description. So even before we get started, I want to ask just the audience, what is something worth? Just anything. What is anything worth?
What somebody's willing to pay for it.
We got that. We got it. So what something is worth is what someone's willing to pay for it. So when we think about why real estate has value, real estate is something that, you buy it and then what happens? You ideally generate rent, right? So it pays you a certain amount of money every month, every year. You're making money on your investment. So essentially, when you buy real estate, you're buying a stream of cash flows into the future. So you put $100 down, you're getting $10 back every single year. You're making a 10% return on your investment. And I like to start thinking about investing that way, because we can get really deep into the weeds of all these financial models and analytics and all this kind of stuff. But at the end of the day, that's all real estate really is. A lot of deals you can start by underwriting on the back of the napkin. In fact, that's how people have been doing deals for most of the time. So before they had Excel and fancy calculators, you were still able to do deals. So how did you do it? You just say, oh, I think I'm going to make this much rent. It's going to cost me this much money. Here are my expenses. Here's the return I'm trying to make. And that's what we're looking at. And so, from, I think, a broker's perspective, Brian, when you're trying to come up with the valuation of your deals for your properties, what's the number one thing or the couple of things that you're looking at for your clients?
Looking at income and expenses.
Yeah.
Come up, see what the NOI is, and that's the real
Mhm,
kind of quick and dirty back of the napkin.
mhm. And then
So,
you have the cap rate. And does everyone in here know what the cap rate is or how to define that? Does anyone know?
go ahead, Jen.
It's actually the ratio of the income to the price of the property. So
Yes, exactly.
IRV.
So essentially a cap rate on a property, right, is if you buy a property in all cash, you buy $1 million apartment building, it gives you $100,000 a year in net income, then your cap rate is $100,000 divided by 1 million equals 10%, right? So that just means if you bought that building in all cash, you'd be making essentially 10% return on your money every single year, not accounting for inflation and this and that. Are you going to add value to the property? Essentially just kind of a very basic understanding of where you are with the valuation of the property. So when you get sent a property blast like this, Brian sends out hot new deal, fresh off the presses. They say, hey, we got a 142 unit opportunity in Jackson, Tennessee. Here's the units 142, 1983. Here's all the stuff about the market, a couple of the unit mix. Before I even start looking at any of this, I want to make sure that this is worth my time to look at, because just because someone's asking for a price doesn't mean that it's anywhere in the realm of reality, right? Brian, how many people do you work with who often think the value of their property is like a little bit more, or maybe a lot more than what it actually is?
100%.
Every single one, right? Because everyone's, when they're selling,
Except Pat.
they want the most money, right? So you're incentivized to throw out a high number, but just because they're asking for it doesn't mean it's necessarily worth it. But you want it to be within the ballpark. Otherwise, if someone's asking $40 million for what's a $10 million piece of property, then it's not really worth your time even analyzing it. So the first thing, before I even look necessarily at everything else, Jackson, Tennessee, great. Let's assume I like this market. I'm going to pick up actually the rent roll in the T12. So if we could click the rent roll, Joanna. So essentially, and if you scroll back to the left here.
Blow it up big.
Yeah, lots of numbers here, right? But essentially, this is the in-place tenants on the property, the different types of unit counts. I added some columns of my own notes over here on the side, but essentially, here's what the rent is for and the day that people moved in and some of the deposits. So I actually just took all of these numbers here. So I went through all of these numbers of what the in-place rent is. I want to just take that because this may or may not be fantasy, right? This is what they say the market rent is, but I'm not going to necessarily put any stock into it until I analyze it myself. The only thing that I know for sure is that this thing is here. This is what people are actually paying today for a property, right? So if we scroll all the way down to here, a little further, and we got 140 units to get to the bottom here. And if we click this cell, this 11,196, or
Million, what do you mean?
yeah, 1 million, yeah.
Or no, which one?
We're missing. Okay, we can move that thing here in a second. Essentially, this is the in-place rent right now, 99,676 monthly. So I just multiplied that by 12 and I got $1.2 million. Functionally, I added, and then these numbers here, this 1277, I'll just briefly go through it. I assumed you could lease up all of these. I took a very brief average of all of these units and just say very quickly, if I leased up all these vacant units, those are the ones that are vacant here, I can add up to 1.277. If you click this number here, this 702. So what this number is I'm then taking this number of my kind of gross rent and just I'm assuming a 45% operating expense ratio, which is pretty common for Class C multifamily. So very quickly, I'm not even going to look at their T12. I'm just gonna say, I know it costs a lot of money to run these units, it's usually about 45%. So I'm gonna take that rent, multiply it by 0.55, that's my expenses. Then this is my value, or this is my income net of expenses, my NOI here. And then this number here, if we want to click the 11.7, that's 11.7, that's that NOI divided by 0.06. And so that 0.06 is the cap rate that I'm assuming for this property. And the reason I picked 0.06 is because typically right now, and this wouldn't have necessarily been the case a couple years ago, but if I'm buying a property, Class C property, I probably want at least a going in cap rate of about 6%. So I'm taking my NOI, dividing by 6%, and I get 11.7 million. Is that about in the ballpark of what you're seeing Class C property trading right now for going in cap rates?
Yeah, between probably a little closer to 7 right now.
Mhm.
Yeah. Or if like this property, you know, if I just took like the last 3 months of if I did a T3.
Yeah.
You know, and did that and then used 45% on it and actually use their actual expense numbers. The cap rate on it was like 7.3, right? Which for Jackson's very good. you
Right.
know, and Plus you got it, it's gotta be somewhere around the same number of whatever the lending is gonna be on it, right?
Yeah.
You know, and if they're doing a conventional, then they're gonna be probably in that 7 range.
Mhm.
Now, if they go agency, they're gonna be like 5.5,
Right.
but to your point, if you do it set, at 6, then you're, getting agency and you're gonna be at 5.25, then, you're coming out okay.
You're coming out okay. And what Brian's talking about, you want it to be higher than your debt, right? He's describing you wanting to have positive leverage. And positive leverage just means that ideally your rate of return on your property is higher than the interest rate you're paying on your mortgage, right? Because otherwise you're underwater. Every dollar of debt you take out is actually worsening your cash flow pretty significantly. So if you're getting a 5.75 mortgage or 5.25 mortgage, and you can afford to get a 6% cap rate, if you're getting a 6.5% mortgage, then all of a sudden you're only getting 6% return on your money. You're actually in a worse spot than the bank, right? And as the equity position, as the investor, you don't want to be making less money than the bank is while you're in a riskier position.
Right.
So anything confusing so far about what we're going over? Okay. The next thing that usually like to do then is we want to take a look at the market, right? And where is this site? And we don't have to pull it up right now, but Brian, do you want to tell us a little bit about Jackson and kind of, I would go to the broker, send this to me and say, hey, tell me about Jackson. Tell me what's going on.
It's on that first tab.
Yeah, I have a little bit on the first tab of a
Yeah.
couple of things that, oh, the notes. Yeah.
Right there. So Jackson's a very booming, and we could just have, we have Lisa come up and do her spill on Jackson that she did last Thursday. Because we had her cover the Jackson market
Mhm.
because she invests in Jackson. So she knows a lot about it. So, but Jackson's a booming area right now. Right. And so, as a broker, we're always trying to look at the next Jacksons and the next areas that are just gonna take off, right? Because as a broker, I'm trying to represent my clients to say, hey, you ought to invest in this area because right now, you may be 60, 70,000 a door, but a year and a half from now, it's gonna be at 90,000 a door, right? So you're better to try to get in now and so this is some of what we sent out on this property, right? You have, Georgia Pacific, starting a $425 million facility. You have, 6K Energy that's investing. You have Toyota. You have, several others and that's not even counting the Blue Oval City that is coming to that area, right? So, and then this property is not in a bad part of town, right? It's in a good, decent area
Yeah.
of town, right?
Off
So,
the interstate.
yep. And so, it's very much, the other thing about Jackson and the area, which, Lisa can tell you all about too, is that the city kind of foresaw some of this growth coming. So, they did a good job of getting all their utilities ready for all of this growth, right? So you look at the counties where the Blue Oval City is coming, they're behind the 8 ball when it comes to all of that, right? So the nice thing is that, all this stuff is coming, all these jobs, this business that's coming. Well, the city's ready for it, right? They're ready to handle it. And that's a huge piece when you're gonna be growing
Mhm.
like Jackson is gonna be growing. So
Absolutely.
was that
Yeah,
kind of
no,
what you were looking for?
exactly what I was looking for.
Yeah.
And like the next question that I'd be asking you, Brian, I'd be on the phone and said, okay, well, the question that everybody asks whenever they get sent a deal, which is, why is the seller looking to sell?
Yeah.
Right? So
Yeah.
do you have any color on that we can
Yeah,
provide?
yeah. This gentleman here has actually only owned this property just a little over a year. Right?
Mhm.
So we get that question a lot because they will look up and say, hey, this guy's only owned this a year. So why is he wanting to sell? Right? Well, he's identified this is 42 units. And one of the things you see with investors is they're always looking to scale up, right? Which means, yeah, they have 142, they're looking to go into something like 300 or whatever, right? Which is exactly what's happening here. This guy has identified a 320 unit property in East Tennessee, and that's what he wants to buy, right? And so because of that, then he's looking to sell this one. He's gonna 1031 that money into that other larger, property. So, I mean, that's the whole thing with multifamily. If somebody starts out with 20 units, they're looking then to, try to move into 40 units or 60 or 100 and scale up, right? That's the whole part of buying
Exactly.
real estate. But
So-
anyway, that's the color into why he's selling.
And that's perfect. So now I'm armed with that color. I know, hey, generally we're kind of in the ballpark. This is worth me diving into a little bit further, right? I'm going to look, if I'm not as familiar with Jackson, which I'm not as familiar with Jackson, the couple of sources I'm going to look for like information further on this kind of stuff, because I want to really know and understand the job drivers for the market. The Chamber of Commerce is always a good site to look at for any municipality, right? Because they're going to be the ones who are most trying to sell, people and businesses to come there. So it's always good to check the Chamber of Commerce website. I started Googling, and then people talking about Blue Oval City, the GP plan. So you're hearing all these things that Brian's given to me, but I want to, confirm for myself and try to figure out those analytics and drivers myself. I checked out, the drive time to Blue Oval City, it's about 45-50 minutes here from the site itself. Read about Blue Oval City. So once you start like really wanting to dive into a market, it's worth spending some time to understand all of the drivers about it. That's their battery pack plant in Kentucky. So if they're building batteries here and then obviously building the facilities themselves here, this whole corridor, going forward is going to be a huge point of growth. I mean, all of what's great about Middle Tennessee is that we have so much auto manufacturing here now and are so close to so many states. You look at the map, and then the statistic they always like to throw out at the Chamber of Commerce, right, is that some 50, 60, 70% of the US you can drive to within, one day for a trucker. So really just not the West Coast. So, but all of this area within about one day, you can get there with a trucking ship. So that's really important for logistics here. And that's why Tennessee continues to see all this growth. That's really nice. The other thing that I'll look at is in kind of the population change, and you can look that up on Census Bureau. So I'm going to look this up. Jackson itself, over the last 10 years, it looks like Madison County hasn't grown too much, only 0.5% change since 10 years ago, as opposed to what everyone knows for Nashville. You look at Williamson County, it grew 35%. What is this? Rutherford County here grew 30%. Davidson County itself grew 14%. Trousdale County grew a lot, which they started off with only 8K people, but they grew 50% in 10 years. So in comparison, maybe not as much as Middle Tennessee, but them holding strong at all and growing a little bit when kind of all these surrounding counties did lose, significant 4 or 5% population. It kind of shows you the relative strength of Jackson in the Western market. So you want to look at take a look at stuff like that. I had a census tract map up here too. If you want to look at the income for this specific census tract is not the highest. It's like $30,000 or so, which as we're diving into the rents a little bit more, you can kind of see why that area might only support a certain amount of rent. So that's going to be one way you want to look at these properties and analyze them. It's like, how much rent can I actually push? You're not going to be able to push it more than the market can support from people's income, right? And the easy way to think about that, and Kunal mentioned affordability, the pretty standard calculation is you take someone's income and divide it by 12 to get your monthly payment, and then you divide that by 3. So that's about how much you can pay per month. $30,000 divided by 12 divided by 3 is like $850, I think, somewhere around there, top of my head. So that's kind of in that range. Go ahead. Yeah.
What's a good resource or website to find those statistics, like income?